I knew this guy, Doug Parks, and since, we all black folks in here, I can say, he's a white guy. And I knew he was in trouble because he had actually come to me before trying to get a loan. I knew he was in trouble, right? So I called him, I said, Doug, what are you going to do with your business, And he said, I don't know, I'm staring down a bankruptcy right now. I got to figure out a way to, to get out from under this debt. I got all these loans on these trucks and just having a whole bunch of problems. So I said, well, all right, let me put some thought to it, Doug, and, I'll call you back. Reached out to some people I knew, a Merrill Lynch guy, Charles Lazar. Charles doesn't even live in the United States. He lives in Israel most of the time. I called up Charles and I said, hey, Charles, there's this logistics company here in Atlanta that, is in trouble, but I think it's got some legs, and I think if I can get it certified as a minority business enterprise, we could go after some set-aside business, and I could save the business that way. I need some money, though. He said, how much you gonna need? I was like, Charles, give me $1 million and I'll make it happen. He said, I don't know, Antonio, I don't know. Okay. So, I negotiated with Doug. Me and Doug agreed on 1.25 as a purchase price for 55% of the business. The business is actually worth about $3 million, but he didn't know it. We agreed on like a 2%, $2 million valuation. So I got a little bit of a discount. I'm a banker, right? So I go back to Charles and I say, hey Charles, we agreed on 1.2. 55%? Huh? 55%, yeah. Because I need a controlling interest to make it minority certified, right? I said, hey Charles, if you give me $1 million, I think I could buy, 90% of this guy's business. You'll notice I'm playing with the numbers because I'm a banker. So I go back to Doug. I said, hey Doug, if you file bankruptcy, you're done, right? Nobody's gonna touch you because you just filed bankruptcy. Tell you what I'll do. I'll put $1 million in your hand right now. Give me a seller note for $250,000, right? And Charles and I will take over 90% of the business. Stay in at 10% because we want you to continue to run it, and we'll give you a salary plus your equity distribution at the end of every year. And so that's what we did. How much money did I put in the deal? Right. And I own 55% of the business. Charles owns 35%. Doug owns 10. I converted Charles's equity into a senior debt facility off the books because he actually loaned me the money personally, not the business. So if we need to raise more money, that note's not on the books, so I can borrow more money later. So me and Charles agreed on a note. I pay him 8% annually, interest only, on that $1 million. So he gets $80,000 no matter what, right? I don't mind doing that because the business was doing about $3.5 million in revenue, was only making about $100,000, and that's why he was looking to stare down at bankruptcy because he couldn't service the debt on the trucks, right? I came in, being the salesperson that I am, reach out to my people at UPS, reach out to my people at Home Depot. We pick up some routes, we pick up some inventory. Now the business is doing, 6 months later, now the business is doing $6 million. We're on track to do $6 million. This year we're going to do almost $10 million in business, right? 2 years later, almost $10 million in business, right? Against about $1 million in profit, about $1 million EBITDA. I pay Charles how much? $80,000. Right. I own 55% of the business.
You're taking home $500,000 without any capital investment.
My man.
That's awesome.
You just got to know how it works. I didn't do anything anybody with reasonable business acumen just needs to be shown how to do it. Right? Somebody just had to tell you it was possible.
You are blowing my mind right now.
I give this same class, the speech I'm giving you guys, I've given at Emory the last 3 years at Emory at the Goizueta School of Business in their private equity class.
Wow.
I'm telling white kids how to do it.
Wow.
I've been trying to tell my own people how to do it for years. I'm still waiting on Morehouse to call me back. How many people went through the home ownership process and trying to buy a house? Anybody done that before? Right. So the equity is how much money you're putting down, right? The debt is the mortgage. It's the same way with companies, right? There are a few other things you'd have to do, like, with a company, like you might need some equipment, but that's like having a car loan, right? You might need a truck or two. You might need a couple of forklifts. You might need copy equipment. You might need computers. You can finance that stuff, okay? So That's debt. Equity is the money you're putting in yourself or raising. Debt, equity is money you don't have to pay back. Debt you got to pay back. Equities, you can't get rid of equity. So you got to be careful bringing in the equity partner because you can't get rid of them. And if you take on an equity partner, just make sure they're somebody you don't mind working with every day. Yeah.
Well, you could buy them out, couldn't you?
You can. That's expensive, right? Because they got in at one rate, at one price.
Oh, right, but
And you want to buy them out after the company's grown. Now you owe them.
exponential.
That's right.
Which,
You don't want to buy out debt. You want debt to exit with you at the liquidity event, right? At the time you sell the business on to the next party, right? All businesses, this is what, if you've never been to business school, I don't know how many undergraduate business people we have or graduate business people we have. If you're not a formal business educated person, this is rule number one. All businesses will be sold. All of them. All of them. Whether that's to some buyout fund, right? Whether that's to independent third party, me coming up to buy your business, right? Whether, that's to another company in your industry, they're buying you, right? Or whether you're in orderly liquidation on the courthouse steps, you will be sold. Every business will be sold. Every last one of them. If it's a family situation, it might be a dad selling his business to his son, right? But every single business will be sold. Okay? So if you don't take anything else away from this, know that every business will be sold. Let's talk about the different forms of debt, because there are different forms of debt, right? So senior debt, which is like the mortgage on your house, right? Subordinated debt would be like the line of credit on your house, right? And you can have senior and subordinated debt. Another name for subordinated debt oftentimes is called mezzanine financing. It is oftentimes at a higher interest rate because it's unsecured. It's like your credit card. It is unsecured. So oftentimes at a higher rate. There are a lot of mezzanine funds here in Atlanta. Atlanta is actually fertile ground for mezzanine financing. Not a lot of private equity funds. There's like maybe a dozen right now in Atlanta that are active. And there's probably another dozen mezzanine funds as well. That money is really expensive and you got to be careful with it, okay? Because, it's at 10, 12%. So it's like credit card debt. Equity. There are several sources for equity. There are your larger, let's call them private equity funds that have money and they seek to buy out companies. Either take a controlling interest in a business that they want to run themselves and install their own management team, or they want to invest alongside a manager who is currently operating and they just want to be in that market, right? Say you own a software company. I like you. I think you're a sharp guy. You do network security focused on the logistics industry. We like that. We think there's a lot of growth there. So I'm going to offer you $5 million in exchange for, it's like Shark Tank, 20% of your company. And we're in it with you for the long haul. If you need more money down the road, we'll provide you with more money. If you need additional support to get a senior credit facility, we'll help you with that, right? If you need a line of credit, we'll help you with that. Those sorts of things, because we want to turn your $20 million business into a $200 million business, right? And then sell it to Microsoft or something so we cash out. And now, that $5 million investment for 15% is worth $35 million to me now. Right? That's the idea. So that's one. And on the small business side, you have venture capitalists, right? Now, the reason they're referred to as venture capitalists is because it's risky. What they do is really risky. We call it, in financial services, we call it the spray and pray method. Right? These guys go out, they raise $100 million in a VC fund. They want to invest in as many companies as possible with that $100 million. They don't want to put $20 million in 5 companies. They want to put $1 million in 100 companies and play the odds. Right? Hoping that there's a Google in there somewhere. Hoping that there's a Uber in there somewhere. Right? Here in Atlanta, what's my guy? Up in Buckhead, runs Atlanta Tech Village. Pardot, right? We're hoping there's a Pardot in there somewhere, right? Some company, I gave him $1 million 5 years ago, and we just sold it for $300 million. Right? I turned $1 million into $30 million because I took 10% when I gave him that $1 million. Right? It's a spray and pray method. Okay? So that's venture capital. All right? And then there's public equity, right? What we should do at Merrill Lynch, take companies public. right? So you might come to me and say, hey, Antonio, you know, I spent the last 10 years of my life, blood, sweat, and tears, building my business. We're going to do 50 million this year in business. We're going to do 6 million in profit, 6 million EBITDA, right? And I'll explain what EBITDA is in just a second. What do I do now? How can I grow from here? Well, you got a pretty nifty business. You guys are a middle market company. Maybe we look at taking public money and doing an initial public offering. We register with the SEC, right? We register with the New York Stock Exchange, get you a stock ticker, and we hold a public offering. Put those shares out into the public market and allow people to buy your shares from their financial advisor or from their brokerage firm. That's an initial public offering, right? That's public money. So you got private money, public money. Private money is your private equity guys, your venture capital guys. The public money is your IPO, which you would go to, you know, one of the investment banks and allow them to put your company on the market. EBITDA, earnings before interest, taxes, depreciation, and amortization. It's an accounting term. Nobody even really knows what it means. It means something different depending on every financial institution you go to and how they calculate what that is. It is a term of art that's used to confuse people that are not in the industry. But it's primarily what your margins are after you pay all your bills. It's what your real money is. What's this business really doing? And there's a few different ways to look at that, right? That's what the term EBITDA. So if you hear somebody say EBITDA, all they're talking about is profits. The net number. What are you really making? And then the valuation of a business will be some multiple of that. And you can research what the multiples are. A lot of times, like when I was, you know, looking at logistics companies, I said, well, what are the publicly traded logistics companies trading for? Right? What's their price earnings ratio? That'll let me know what the multiple is for the private market, right? And then I want to negotiate it down from there. Right? Praying that this guy didn't read the Wall Street Journal this morning just like I did. Right? It's it's all arbitrage for me. I'm playing the spread, right? If I know they're trading at 8 times EBITDA, right? I would have come in, I would have offered you 5 times EBITDA. 5 seems like a fair number. Why wouldn't it? You don't know what the EBITDA number is. I do. So I can make money day one, because if I know the fair market value for a logistics company is 8 times EBITDA, I paid you 5 times EBITDA for your business. I could flip your business tomorrow for 8 times and make my money back. It's all arbitrage to me. Where can I go to get debt? You can go to the bank. There are SBA lenders out there. There are commercial credit companies out there. A lot of the banks have commercial credit companies. Say you go to the bank says, well, if we're going to give you this $1 million loan, you got to be worth $1 million. Right? If I'm worth $1 million, I don't need your money. Right? Banks only loan money to people that don't need it. Right? It's got to be out of sheer convenience. It can't be a need. If you need $1 million, I can tell you before you walk into Wells Fargo, you're not going to get the loan. Right? Right? If you just want $1 million, right? I got $3 million in the bank. My house worth $1 million. Yeah, I'll give you $1 million loan because you don't need it. Right? If you need the money, you need to go to a commercial finance company. Wells Fargo has what they call Wells Fargo Business Credit, which is actually a very deceptive name because it's not based on credit at all. It's an asset. They're an asset-based lender. BB&T has BB&T Business Credit. They're an asset-based lender. They're going to look at what your accounts receivables are. They're going to look at what your payables are. They're going to look at what your inventory is. They're going to look at how much equipment you have. And then they're going to loan you money against those assets. So if you have, say you got a government contract, right? And you've already done $1 million worth of work for the government. You've already billed them for $1 million. But you're like, hey, I'm so far into this contract, I don't have enough cash to make payroll. You can go to BB&T Business Credit with that invoice and say, this is $1 million invoice. How much can I take out of this now? Because I can't wait the 60 days it's going to take for Georgia Department of Transportation to send me my money. Because they got a 60-day turnaround on invoices. I got to make payroll next week. They'll loan you typically up to 65, 70% of the face value of that invoice at 1% to 2% per month. So if you annualize that, what are they really charging you? Yeah, anywhere from 12 to 24%. So business credit money is more expensive than the bank. You got to have decent personal credit on that, but it's really based on the credit of the invoicee. Who is that? Who's paying your invoice? If it's a government invoice, you're in pretty good shape. You know, I've had to do something along those lines with Home Depot because it was taking them forever to pay me, and we were having cash flow problems. So I had to take that Home Depot invoice to Marquette Commercial Credit, because I know a guy over there, right? And use that as short-term financing. And I paid him a point to do the origination, and then I paid him another point to pay it off. So it cost me 2% for 30 days. So that's how you could do senior debt for business.